Hello everyone, and welcome back to Kumari's Commerce Hub. I hope you all are doing great. So in today's lecture, we are going to study another important capital budgeting technique called internal rate of return or simply IRR. So in our previous lecture, we discussed the net present value method, and today we will build upon that concept and understand how IRR works. So by the end of this lecture, you will be able to understand the meaning of IRR. You will also be able to understand how to calculate a numerical, that too step by step. And also we will learn about the advantages and limitations. Now, before moving to IRR, let's quickly revise what we have learned in our previous lecture. So in that lecture, we have covered NPV, in which we compare the present value of future cash inflows with the initial investments. So the decision rule is very simple here. If NPV is positive, we accept the project. Why? Because it creates value. Now, if NPV is negative, we reject the project because it is not providing the value to the project as we were expecting. Next is if NPV is zero, then it is indifferent because the project is neither creating the value nor destroying the value. So NPV tells us how much value a project creates. Suppose a manager asks, this project is good, but what percentage return will it generate? So NPV cannot answer that question. For that, we use IRR, that is internal rate of return method. Now let's understand the meaning of IRR. So please write down this particular definition. So IRR basically is the discount rate at which NPV of the project becomes zero. Let's understand this in a very simple way. When we calculate NPV, we first find out the present value of all the cash inflows in future cash inflows. Then we subtract it with the initial investments. So if the present value is greater than the investment, the NPV is positive. And if present value is less than the investment, then NPV is negative. Okay, so this was the formula that we have used while calculating the NPV. Now there is one particular discount rate at where the present value of cash inflow is equal to initial investment. And if that happens, then at this point NPV is zero and this discount rate is called the IRR. So in simple words, NPV tells us the value created by a project, whereas IRR tells us the percentage return generated by a project. Okay, so this is very simple to remember. Now that NPV tells you to what is the value created by a project, and IRR tells you what percentage return is generated by a project. Now let's understand this concept with the help of numerical. Suppose a company has made an initial investment of $10,000 and the expected future cash inflows are for the first year we have $4,000, for the second year we have $5,000, for the third year we have $6,000. Now our objective is to calculate the IRR. Since we don't know the discount rate at which NPV becomes zero, we will use trial and error method. So for that, you can take any discount rate, like you have to assume. Okay. So we are beginning with discount rate of 10%. Like I have taken this 10%. Now here you have to do the calculations. Okay. So firstly, we have to calculate the NPV for all the years. So we have calculated and we have basically got the total of NPV, which is 12,276.48. So our NPV is basically total present value minus initial investment. So we are left with a positive NPV of 2,276.48. So this NPV is positive now here. So this means the project is still creating value and we haven't reached the internal rate of return. So to move closer to IRR, we will increase the discount rate. Now I'm going to increase it by 10% again. So I'm going to take 20% here. Now I'm going to do the same step again. I'm going to repeat that process again. Like again, I have to calculate NPV, whether the NPV is positive or not. So I have to do the same step again. So now after adding all the present values and subtracting it with the initial investment, I have got the NPV, which is 277.77. Now notice that NPV has reduced significantly. Now this happens because the discount rate increases, the value of future cash inflows decreases. However, the NPV is still positive, so we will increase the discount rate once again. Now I'm going to increase only 5% because earlier we have increased the 10% and we have came to this point that we are left with 277.77. So I've increased it with 5% and now we have 25%. Now we will calculate the NPV using 25% discount rate, and again we will calculate the present value for each cash inflows and subtract it with the initial investment. Now we have got the NPV of minus 528. Now we have exactly what we needed. So at this point, like at 20%, the NPV is positive, and at 25%, it is negative. This means that the IRR is somewhere between 20% and 25%. Okay. So to know exactly where what IRR is, so we are going to use interpolation method. Okay, so we are going to use a formula for that. So we have this formula for interpolation, and now we are going to substitute the values in this. We had a lower discount rate of 20% and NPV was 277.7, and then for higher rate we had 25% minus 20%. Okay, so we are going to substitute all the values and we are going to get the IRR after calculating is 21.72. Now therefore the IRR for this project is 21.72. We have to make a decision. Okay, so to understand the decision rule, you have to understand that if IRR is less than the required rate of return, the project should be rejected. You don't have to accept it. And if it is greater than what we are expecting, okay, then we are going to accept the project. For example, if company's required return is 15%, then our project gives 21%, then we are going to accept it. And same thing, like if a company required only 15% return, but our return came out to be like 10%, then we reject it. Okay. So this is simple rule. Now let's discuss the advantages of IRR method. Firstly, it considers the time value, like we have, like in NPV also it considers the time value, okay? But it considers the time value of money. It also considers all the cash flows, okay? And the results is expected as percentage, so making it easier to compare the project, and it is widely used by the companies for the investment decision. Now if I talk about the limitations, like every method, this method also have certain limitations. Now here it is based basically upon trial and error method. Okay, so manual calculations takes a lot of time, and secondly some projects may not produce multiple IRRs, and some may produce multiple IRRs. So in some situations, IRR and NPV may suggest different decisions, especially when comparing mutually exclusive projects. All right, so this is the limitations of it. And if I talk about what we have learned today's lecture is like we understood the meaning of initial things like the internal rate of return, and we also learned about like how we use trial and error method for calculating IRR, and we also discussed the advantage and limitations. So I hope this lecture has made the concept of IRR easy to understand. And if you have found this video helpful, please like the video, subscribe to the channel, and also share it with your classmates. And thank you for watching.